Let's look at Dave and Buster's. And we want to calculate the intrinsic value of the stock. And in order to do that, we need to estimate the future free cash flow of the company, discount that back to today's dollars, and then divide it by the shares outstanding to come up with an estimated stock price. Now, let's get started. What's their market cap? 558.1 million. Okay. And what is their stock price? 1203. So they have 46 million shares outstanding. And let's get some of their financial information. Cash flow is the most important part of a business because it's the reason people invest in businesses. Think of if you bought a business, you would want to know how much cash is left over after I operate the business, because that's what the owner receives. We are owners of the company. Even though we own a small part, we're still owners, and you should think of a stock as owning a company. Now let's see the net income. The numbers seem fairly consistent. As you can see, there's a big pop in cash flow in 2018. So you can always look into their financials, look into the 10K to figure that out. But we're not going to go into that much detail in this video. We're taking the numbers as they are. But any good analyst would dig into numbers to figure out the answer. Now the revenue. So it's about $1 billion to $1.3 billion. You can see revenue is the smoothest number year to year. How it grows a little each year. When net income and free cash flow aren't as smooth. They're a little bumpy. You had a pop up, then a drop down, then another drop down. So there's reasons for that, because in net income, things are depreciated. There's accounting tricks, so a company can manipulate the numbers. Not so much in revenue and free cash flow. It is what it is. So now we need a capital structure of the company. Now let's see if they have what their interest expense is. 20 million. Now we need to see how much debt they have. We'll go to the balance sheet for that. The liabilities section. We need a current debt. That's debt due within 1 year. 15 million. And the long-term debt is usually the debt that's much larger. That's debt that's due beyond 1 year. It's a good idea to check the 10K to see when the terms are, because you want to see if there's a lot of debt due, maybe in 2021, or maybe it's not due for a long time. So they pay 3.13% interest on the debt. But as you know, interest gets a tax deduction, so you get a little discount based on your effective tax rate. Let's see what their effective tax rate is. So their income before tax is 127 million. Their income tax is... So in order to calculate their cost of debt, we take the 3.13% times 1 minus the effective tax rate. And the cost of debt is 2.47%. So that's how much it costs the company to borrow money through debt financing. Now we need to figure out how much it costs the company to get money through equity financing. And the beta is 1.61. So the cost of equity is 14.68% because it always costs a lot more for equity. There's a much greater risk when you're an equity holder than when you're a debt holder. Because when if a company goes bankrupt, the last people to get paid are the equity holders, and way before that is the debt holders. So now we know the discount rate, the weighted average cost of capital, to 8.12%, and we discount the cash flows I calculated by that discount rate, and we get a present value of the company of 1.8 billion divided by 46 million shares. So we calculate a stock price of $39.64, even though it's trading at $12.03. That's 70% discount on the stock. And you can see the stock price the last few years. It was trading about at intrinsic value, which is interesting. A little above intrinsic value sometimes, but around intrinsic, $40. And then it dropped off a cliff when coronavirus hit. Now it's trading well below intrinsic value. Why is that? Because the past is not always indicative of the future. The past indicates they're worth $40, but apparently investors feel it's not worth $40, so that's why they're not buying it, and they drove the price down of the stock. And I think that's going to be. So thanks for watching the video.